What is going on, everyone? My name is Kenneth Beard, and today I'm going to be breaking down the short call vertical spread. I'm going to be breaking down some things to look out for before placing a short call vertical spread, how to place a short call vertical spread, and just some factors that I pay attention to when placing a short call vertical spread. So, short call vertical spread is essentially a bearish assumption in the market that you are trading. So uh, when you're looking to place a short call vertical spread, you're looking to have a bearish assumption. So you want the price to move away from your short strike. So with that being said, I'm going to break down just two option Greeks really quick that I pay attention to that are really important that you want to also take note of as well. So the first one is delta. Delta is for every $1 move, the option will increase by this delta amount. And so, for example, let's say you had an option that was $1 or $2, and the delta was 30 cents. So after that first dollar move, the option premium would then be $2.30. So that's what that means. Now, gamma is just an extra variant or another variant of delta. Gamma is the rate of change of delta. So gamma goes into delta for the second dollar move. As you see, rate of change for delta comes into play after underlying second dollar move into so basically comes into to play after the underlying second dollar move, and the gamma goes into the delta. So the delta is the one that's going to be affected here, but the gamma is just showing you by how much the delta will be affected after that second dollar move. So, for example, let's just say the delta is after that second dollar move. After that first dollar move, the delta is $2.30, and let's say now you have a gamma of 0.5, 0.05, and delta is going to now be 0.30, 0.30 plus 0.05. Not putting that. What am I doing? Okay, let's do that one more time. So the delta is going to be 0.30 plus 0.05, which is, now this 0.5 is usually on the option chain. You're going to see something like this. That's where the gamma is located. It shows you here. So let's say that the gamma is 0.05. Now after that second dollar move, this gamma is going to be added in before that second dollar move, take that back. So after that first dollar move, the delta is automatically going to change. And this is going to be puts, when that dollar move, second dollar move happens, the delta will then be 0.35. 0.35. That'll be the new delta. So after that second dollar move, so after that second dollar move, your 230 is going to be plus 0.35, which is going to equal $2.65. That'll be your new option premium after that gamma comes into effect, right? So the gamma is just going to go into effect after the underlying second dollar move. So as soon as that delta increases, the new delta will then be 35, and then when that second dollar move happens, that 35 is going to be added into the option pricing, making it $2.65. So that's when it's moving higher. When the option is moving lower, the delta becomes negative. The gamma will stay positive, but it will decrease the amounts that the delta is going down. So, because you're going to be adding a positive to a negative, which is going to decrease that full delta amount. So that's how that works. So I'm not going to get too deep into that. I just want you guys to understand basically what those mean. Keep those in your handbook, delta and gamma. The delta is after the first dollar move, the gamma is after the second dollar move, and that is the rate of change. So that is being put into the delta. So let's, for example, say that you were watching the SPX, and this is for an example. I'm not a financial advisor or any type of way. Don't look at me for any financial advice. If you look at me for any financial advice, you will lose money and you lose all of it. So don't listen to me. So this is for example. Let's say, for instance, you were looking at the SPX. You see that the SPX is overbought here, and you potentially think that it's topping out, and it could potentially roll back over, maybe pull back towards these EMAs, maybe pull back, retest highs, something like that. Well, what you would want to do is you would want to go to the option chain, and let's switch this to the right ETF. So I'm looking at SPX right now, because I trade SPX, by the way. Let's go like 7 days out here. All right, so let's say we were looking at some calls and we wanted to short, right? Let's say we want to short up here at 30, 80, 60. Well, we will go, and when you place a call credit spread, essentially what you want to do is you want to sell a closer to the money leg. So your first leg wants to be the closest to the money. The long leg, you want to place that one further away from the money. So this one should have a lower delta. So this delta here is 40. Your long leg should have less value. That way you get a net credit. So when you sell that out of the money, when you like, let's say if you were to just go ahead and sell straight, single, well, that's going to cost you $20.70. So that's going to cost me $20,000. Don't want to do that, right? So let's add a leg on there. The way you add a leg is on Thinkorswim. You can go here, you can go to sell, you can go to vertical. And when you do that, what it does is it adds this leg right here, which is the 38.65, which is $5. I usually do $10 spreads, but this is a $5 with spread. So it's going to be selling this 380. Which one is this? This 380.60, and it's going to be buying back this 380.65. This is going to give me $2.20 worth of credit. Now, when I put this on, let's say we go here, it gives us a max profit of $2,000, and it shows us our max loss. So when it shows us that, what happens is when you place one of these, I'm 7 days out the money, so this delta is going to show, this delta 40% chance that this option could expire in the money. So the closer you get to the money, the less risk you'll have to put on. It still is risky because there's a higher chance. There's a 40% chance. You also look at probability out the money. This is 60% chance of this staying out the money, which isn't completely certain. There's a very high chance that it'd come down and I could, end up being in the money at expiration, which would, be a pretty big loss. So we don't want that to happen, right? So what you want to look for is, I look for like the 36 delta. I usually go around there, but let's say just hypothetically you want to sell this. What you're doing is you're going to sell that 380.60 and you're going to buy back that 380.65, lending you a net credit of $2.30. So that is the first part of this trade. So your max profit is always going to be the premium that you receive. Your max loss is going to be the spread between the strike prices minus the net premium received. So the width between these two strikes are $5. $5 minus $2. Let's say $5 minus $2, which was what's the premium I received? $2.25. $5 minus $2.25 would be $2.75. $2.75 times 10 contracts, which is equivalent to 1,000 shares, would make my max loss $2,000.750. That is the maximum amount that I can lose at expiration. Right. So you want to keep that in mind. That is the max loss that you can lose. And the break even on this will be the short call strike price plus the net premium received. So this short cost, and if you're using Thinkorswim, it does all this for you on the order confirmation tab. But just to know what the calculations are of these things. The break even is the short call strike price plus the premium received. The short call strike price plus the premium received. So the short call strike price is $380.60 plus the premium received is $2.30. So that will be, of course, $38.62.25. So that is, basically all the things around a call credit spread. So what you want to do is you want this to expire when you're placing one of these trades. You want this to you want the trade. Let's say we place this. We want this to roll over. We want this to continue to move lower. We want this to continue to move lower. Our short strike will be up here somewhere, and we don't want it to continue to move, because if our trade goes in the money, well, we would come to max loss. We'll go into max loss and be in the money. There we would have to pay whatever it is at expiration if we let this expire worthless. For the short strike that we had, basically. So you want this, when you're placing one of these trades, you want it to stay away from your short strike. You want it to stay below. What I do is when I'm placing one of these trades, I'll have like certain areas, or I'll get out up here. I'll get out 5% away. I'll get out at a 30% loss. If my spread gets to 30%, I'll cut the trade, and just based on how much I'm willing to risk. So that is a short call spread. That's how you and then I'm not going to get over in another video I'll break down how to use the analyze. Basically telling me there's a